Hello. On behalf of ACG Los Angeles, welcome to the latest installment in our webinar series. This afternoon, we're discussing COVID-19, cash and credit management. We have over 300 viewers on today's webinar, so clearly we've tapped into a very timely and interesting topic. Our moderator this afternoon is Brian Davidoff, a partner at Greenberg Glusker, and we're joined by Brent Horstman, a partner at Shepherd Mullen, Adam Feit, Market President for the Los Angeles region for Union Bank, and Brandon Ferreira, Southern California Market Executive for Fifth Third Bank. Now, Brian, I know we have a lot of great content to get to, so please, let's get started.
Thank you, Michael, and hello, everybody. Afternoon to you on this rainy Thursday afternoon. Yeah, you're right. We have a lot to get to this afternoon, and clearly this is a very topical issue, one that day by day, the information needs change. We're all trying to navigate this both for ourselves and our clients, and the purpose of today's panel is to try to give us all some insight how to manage this process, how best to advise our clients, how to assist our clients in dealing with the cash management issues that they're all facing. Part of the intention of the program is really to get behind the formalities of the various government stimulus programs out there, talk to some of the people who are advising clients. Let's learn what it is that they are sharing with their clients. Let's learn what the bankers are sharing with their borrowers, so that we can all get some better insight and understanding about how really best to help our clients. So one of the topics that I want to begin with is what is really the central part of the program, which is cash management. All of our clients are clearly cash starved. For most of the country, businesses are shut or almost shut. There are government stimulus programs, as we all know, that are supporting payroll. So cash is king. We have seen in this current environment a lot of companies, from the largest companies in the United States, from Best Buy to Yum Brands, GM, Ford, Williams-Sonoma, and a bunch of other household names, have drawn down on their credit facilities either entirely or almost entirely. There are, as we know, provisions in various loan agreements. Some are discretionary, some are mandatory to make credit available. And so one of the things that I wanted to begin with is, before we get into how the banks are managing the government programs that are ongoing now, what are the bankers looking at when their customers come to them and want to draw down on their credit lines? So let me begin with you, Adam. Number one, are you seeing that? And number two, to the extent that you are seeing that, is there any further scrutiny which you are looking at as to those drawdowns?
Yeah, sure. So in terms of the drawdown activity, we've absolutely seen it. I think the public number said about 200 billion has been drawn down from revolvers and other uncommitted lines of credit. So you've seen a lot of volume there. I think initially at the beginning of this, there was a lot of panic drawdowns. CP market was seizing up. So you saw a lot of the larger borrowers draw down billions of dollars at a time. With the government stepping in, a lot of that's gone away at the kind of large end. In terms of middle market borrowers, we've seen it probably more from the private equity firms. We've had a number of private equity firms that have given direction to the portfolio companies to just draw down across the board. So we have seen that pretty frequently at the beginning. But our traditional middle market borrowers, there have been a lot of calls to bankers just trying to understand the health of banks and the need to draw downs. And I think when they collect a lot of the information, a lot of them have chosen not to draw down because the banking system is still in very strong shape right now. We've definitely seen activity across the board.
How about you, Brandon?
Hey, can you hear me?
We can hear you.
Okay. Well, I couldn't hear Adam, so I apologize if there's any repeat. But yeah, I mean, I think we've seen a lot of companies draw down their revolving credit facilities, and we think, you know, we understand why they would do it. I think the one thought that I would add is, I think during the Great Recession, you know, there was rampant fear about the solvency of banks and the banking system in general, which drove a lot of that activity. And it seems, you know, in this environment, that the change in regulation on the banks that's required higher capital, more liquidity, that appears to be less of an issue, and that, you know, I think some of the defensive draws on revolving credit facilities are more, you know, companies wanting to make sure, you know, less that they're worried about their bank and more that they want to make sure that the liquidity is in its most liquid form in their checking account. So
Brandon, can you hear me okay?
Yeah.
Okay, so when these events are occurring with your borrowers, when they're looking to draw down on their facilities, are you having a conversation with them? Are you talking to them about what alternative sources of cash might be available? Are you looking any more closely at their covenants? Is there any further diligence that's going on before they draw down?
I'd say in certain instances there is, but in general, you know, you know, our duty as lenders, if a borrower is in compliance and they request to draw on their revolving credit, you know, we're committed and obligated to fund that. I think our bank and all the banks have been having a lot of active dialogue with clients in general to check in and understand who's going to need the bank's assistance to get through this. And so I guess I'm kind of saying yes, but the conversations are having without regard for the drawdowns on the credit facilities. I think we're funding our commitments, you know, as you would expect a bank to.
Adam, let me punt that question to you. Or would that be a similar answer from your perspective?
Sorry, over to me?
Yeah.
Okay. Yeah, I missed that. Yeah, I mean, it's been pretty consistent with what Brandon said. I mean, we've had, like I mentioned, a number of requests. We funded all of them. You know, certainly are looking at agreements, but, you know, concerns around MAEs and that type of legal language. We had one situation where they looked to get that waived just out of abundance of caution, but you know, we're taking the stance, you know, that this is available for companies to draw on. We're funding it every time.
So before I ask Brent a similar question, I know that the audience consists of some legal folks out there, a lot of financial folks out there. And so this program and this discussion, I should say, is really not intended to be any deep dive on any particular legal issue, but more a practical application of what's going on today. Let me just mention that, as we probably are all aware, loan agreements may be either in a discretionary form or a non-discretionary form. And to the extent that they're discretionary, there's a lot of cases out there that say, absent clear language to the contrary, that the lenders are required to fund. And they need to do so in good faith. And again, for the lawyers out there, there is a particular section of the Uniform Commercial Code, section 1309 of the Uniform Commercial Code, and it's in the California Commercial Code, where it provides that to the extent that a loan agreement allows a lender to accelerate the loan or to not fund the loan if it deems itself insecure, then the lender's got to act in good faith. Obviously, in the case of a non-discretionary loan, you look at the particular loan covenants and the loan provisions. So with that little legal background, Brent, let me ask you the question. Are your clients coming to you either from a borrower point of view or a lender point of view, looking at and asking your advice, should they draw down? And have you run into instances where they've requested such a draw and then it hasn't been made?
So most of them have already made the decision by the time they've come to me, and I have both lender clients and borrower clients. But I would say, especially that first week, and I view as when the NBA shut down is when folks started taking this really, really seriously. And so that first week after that happened, we had a lot of clients. We had lenders who were kind of looking at it proactively. Well, what happens if my borrower comes to us and asks for a full drawdown? And then we had some borrower clients that were obviously asking, can we make all of our reps? Because most loan agreements will have, you'll have to bring down your reps. You'll have to bring down the MAE rep. So we did see a lot of clients bring down their lines. We didn't have any lender clients that didn't honor that. And we had a few that actually had defaults already occur because of, depending on the industry, some might have a default in there about remaining open for a certain period of time or having a closure for a certain period of time. But for the most part, what we've seen is the banks have been very cooperative with their borrowers and honoring those requests. I think there's been, when you've got a syndicated deal, there's some issues involved there because you can't unilaterally waive some of those conditions. So sometimes that's come up and we've had to get consents from the bank group, but those also were pretty freely given.
So let me ask you a follow-on question, Brent. Other than drawing down on revolvers or lines of credit, generally, what is your advice being to your clients regarding cash management?
So the first rule I've been telling them is to stay close to their bankers because I think everybody's been, we're all going through this together. People are trying to find a way out. Banks are not trying to find a default. So that's rule number one. The other things, so going into that second week, you had folks having payments due on March 31. So we advised a lot of clients to go to banks, and we were advising lenders on granting deferrals, which once again, folks, especially in terms of amortization payments, seem to be willing to kick those out a quarter or tack it on at the end as a balloon payment. So that was another thing that we were advising a lot on during that second week.
Sounds good. Thank you. Back to the bankers. In this environment that we're currently dealing with, where everything has been upside down and we're trying to right size it now, is credit still available? Is new credit still available? Are you seeing new deals being done? Adam, let me begin with you. What's your perspective of that? Are you there, Adam?
I'm happy to jump in on that from the lawyer side. I'll tell you what I've seen, which is we've actually gotten several new deals in. Some were specific to liquidity issues related to COVID-19. Others were deals that were just in the pipeline. I think, though, a lot of the attention of the banks is obviously dealing with their current portfolio. And frankly, I think a lot of the borrowers are also dealing with their own issues, non-credit related, relating to a lot of labor and employment issues, which is another part of our firm that's been very busy, dealing with how do we deal with stay-at-home orders and the like. So I think our sense is that the banks are still in business, and that's what our clients have told us. But I think, to be candid, I think obviously there's been a lot of attention paid initially just to the borrower's regular, lines of credit and the like, and then over the last week or two to the PPP loan program, which we'll get into. But I think that's diverted everybody's attention on both sides of the equation.
Adam, are you back with us?
Yeah, I'm back.
Okay, I don't know if you heard the question, but the question was, as Brent, I think, succinctly put it, are the banks still in business? Are new loans being done? Are there new transactions that are still viable?
Yeah, no, it's a great question. Yeah, I mean, I think banks in general are absolutely open for business. I mean, I'll tell you, for us, in the last, week or so. We've put 500 million of new capital to work in the healthcare space. As you can imagine, there are a lot of hospitals that need the additional capital. So that's been something that we've been very focused on, and that's primarily for existing clients, but also for new prospects in the market. To the extent we've got prospects, obviously the management teams that we spend time with already, and it's not a brand new situation where you need to do in-person diligence and plan tours and all that, make it easier to execute. But yeah, I mean, on average, banks across the board, I think, are absolutely open for business.
Brandon, any comment?
Yeah, I mean, I'll add some comments. I got to say again, for some reason, I can't hear Adam. So it's nothing, no competitive dynamics against Adam or Union Bank.
This was just a test to see if you guys gave the same answer or not.
I literally can't hear him. But yeah, I mean, I think demand in the market for healthy new loans has shrunk pretty dramatically, as I think, as you mentioned, borrowers and all customers of all shapes and sizes are focused elsewhere and focused on how they manage their business through this new and very uncertain time. And so I'd say demand is down. However, you know, we've been lucky. We did have some transactions in the pipeline that we were in documentation on, that we pushed to a close over the last few weeks. So we still have been funding new loans throughout the month of April. And, you know, I think right now, the majority of the bank's capacity is really tied up trying to take care of our customers. I mean, customers need us more than ever. And, you know, that's where we're focusing most of our attention and resources, with demand being low from new customers. Although, you know, we're open for business and we're always interested to meet new companies and learn more about them.
Much of the discussion in the last 3 weeks have been about the various stimulus packages that are available. All of us are, I think, to some extent, more or less familiar with these programs. Some of us in great detail, some of us more in a general way. We know about the emergency disaster loan program. There's lots of discussion about the PPP program, the Paycheck protection program. Last night, the SBA came out with their guidelines on the Main Street program for medium-sized businesses, 10,000 employees and more. But what I'd like to focus on during this conversation most specifically is the Paycheck protection program. And again, the purpose of this discussion is not to get into the details of how an application's got to get filled out or exactly how it works, but rather to get some insight from the participants, how they're approaching it with their clients or their borrowers. So Brandon, let me begin with you and ask you, just generally, what's happening inside a bank with all of these loan applications coming in? How are you guys actually managing it?
Yeah, I mean, it's a really important topic. It's what me and my team are spending the majority of our days on for the last few weeks. And you know, the way I would describe this program is it's a high-speed train coming down the tracks, and all the SBA and all the banks are kind of laying down new tracks to support it, kind of as it's flying towards us. And with guidance and directions still being developed and still, you know, coming down in real time. And so I think at the same time, you know, it's for the benefit of our customers, right? And our customers who most need for capital and liquidity to support their business through this time. So there's also, I think, a ton of angst out there that the funds could run out, and that people could miss out on this opportunity that could be a lifeblood for the business. And so, you know, the bank's role here is really, I would best describe it as facilitators we're here to try to help our clients get these funds in a relatively low risk environment for the banks, but to leverage the information that we have and our ability to, help what I'll call check the box or concur with certain items to speed applications through the system. And so, that's where we're focused. And I'd say we're all interested in how we can help new customers with this, and that's definitely a part of the focus. But the throughput and the volume that I think all the banks are seeing from their customers is really high, and it's just taken a ton of resources to make sure we get this done in the right way.
So Adam, let me ask you this. We know that, at least regarding the PPP program, the SBA released its interim final rules last Thursday evening. There was then another Q&A, guidelines in the form of a Q&A that were released on Tuesday and finalized, or at least updated as of today. Do you feel that there's sufficient guidance out there for the bank, or is that an ongoing issue for the bank in the administration of these loan programs?
Yeah, it's another good question. I mean, and luckily I heard what Brandon said, so I try not to repeat any of that. But it's really day by day, and I think every bank is taking the same approach for the most part. And let's just help our customers first and foremost. And so for us, it's kind of an all hands on deck, doing our best to process as many applications as we can for our customers, and hopefully soon thereafter help out non-customers. And really everyone is contributing. There's guidance that seems to come out daily because the amount of questions are endless. But I think at this point, there's enough guidance out there. We're able to get a lot of these applications in the system, ultimately processed. There's always going to be little nuances here and there, which the SBA continues to provide guidance on. But I think the program is working. I think the next week or two, you're going to see most of the funds depleted and utilized for our customers that need it. So we're doing our best. I think it's going to be in good shape and help out a lot of people.
So a question for either of you. Thousands of applications have been processed. Have your banks actually started releasing PPP funds to your borrowers at this point?
Yes. But we're at the very early stages, and we're hoping for a lot more funds in the coming days to be released. I think that hopefully that explains the stage we're at right now.
A related question. One of the purposes of the guidelines is to try to explain in somewhat of an abbreviated fashion what role and what diligence the banks are supposed to be doing when a borrower submits an application. Brandon, can you give us some insight into, at least at your bank, what the discussion has been about what level of diligence needs to be done on a loan application?
Yeah, I would say, most of the diligence leverages the existing file of information that the bank has on a client, right? And that's why it's much easier right now to supply the SBA the information that they need to be verified on an existing client, because we have their financial information, we have all of their know your customer information, and we've verified that previously. So I mean, I think those are big components of this. When we think of diligence syncing up information with our system and with the SBA system. And so I think that's a key part of it. And then the other thing is we're the first line check on the loan amount eligibility component, which is, for those who aren't aware, really a calculation that is based on primarily payroll and provides a multiple on a company's monthly payroll. And so we're doing probably the newest component to these applications is that piece. But like I said before, the bank's roles here are more of a facilitator. The program is designed for the customers to certify and sign off on most of the important information in order for there to be speed and for the funds to be able to be deployed as quickly as possible, despite all the clunkiness that I think there's been in with all the demand. I think that's really where I'd say it's not a typical new loan diligence. It's a confirmation of certain information, and the program is set up for the borrower to certify.
So, Adam, can you hear?
I can.
Okay, so following up on what Brandon said, the guidelines talk about the fact that, as Brandon just said, that the program is designed for the customer to indicate, what the payroll is, what the affiliation is, whether they're under 500 employees or not, whether they meet the SBA small business guidelines. But there is some language in the guidelines which talk about the banks doing some form of testing on that. Can you add any color or any kind of perspective to what Brandon said?
Yeah, I mean, I like the way Brandon phrased it as facilitator. I think that's a good way to think about it. Banks have been tasked to, essentially get these through the system. I mean, at the end of the day, we're seeing all the applications, so a lot of the questions are similar. So we're able to, be advisory and provide guidance on some of the key items. But to your point on, amount of payroll or certain, applications on things, we're letting people know, make sure you speak to your accountant, make sure you speak to your attorney, make sure you're comfortable with the application you're submitting ahead of time. We're here to help. We're here to obviously advise, but, we're not there to fact check every single answer and make sure it's accurate.
So, and I don't know if either of you folks can answer this question, but from the time an application is submitted, and by the way, are you using your own forms or are you using the SBA application form?
We're at our firm, we're taking all types of applications, the old ones, the new ones, it all applies.
Is there an average time, and I know this is all very new, but just so that people can get some sense of what the timeline is, from the time an application is submitted, is there any guidance you can give us on how long it takes before that application is actually submitted by the bank to the SBA?
I'd say that, so right now the timing is as soon as possible. And that's kind of the timing expectation of the customers and of the banks. I think what we've seen in the past few days is that the technology systems of the banks and of the SBA to handle the volume have been tested, and I believe the SBA's system has gone on and offline at different times. And so I think we're figuring out what that is in real time right now, and with all the moving parts that we've seen. So I think it's still a bit TBD, but we are pushing through applications as soon as we can. Once all the information is correct and we've done our check on it.
Brent, anything that you want to add from your perspective, either on behalf of your lender or borrower clients, on actually having them complete the applications and submitting them? We can't hear you.
Hold on there. Better?
Yep, that's better.
Sorry, I would agree with the advice of going to your attorneys and accountants, obviously, and getting them to advise you. We've had a ton of clients come to us, but it does seem, going back to an earlier point about what type of diligence, it does seem, at least in the guidance we've gotten from the SBA, that they are allowing the lenders to rely on some of the certifications. For instance, one of the hot button topics is the affiliation rules. And I think that the latest round of FAQs that came out, they were allowing lenders to rely upon the borrower's certifications. We've seen a couple of lenders ask borrowers to get their counsel to confirm that they are not affiliated. I will tell you that from a law firm standpoint, that's a little bit of a struggle, because then you get into a legal opinion issue. And you don't want to, if speed is the factor you're looking for, getting into a legal opinion fight is not what you want to do. Law firms are also trying to be as accommodating as possible, obviously, with their clients to assist them in these programs. But yeah, I think most everyone is trying to get up to speed at the same time, because first of all, most of us were not built for SBA lending or SBA legal advice. And then on top of it, you layer this program, which at least at the onset had very little guidance, a lot of discrepancies. So, but I think most people are at this point, this week have gotten their handle around it. I know us as a firm had established pretty early on a task force internally that was studying the guidance as it came out, so we could give up to the minute advice.
So one of the related issues in trying to manage cash in this environment is potentially clients coming to talk to people like you, Brent, about looking at the existing covenants in various agreements that they have. We've seen early on in the process that guidance was released from the Federal Reserve and all of the regulatory agencies, the FDIC, the OCC, and even the state regulators, that talked about really encouraging regulated lenders to work with their borrowers. And in fact, the guidance said that to the extent that they accommodated their borrowers by deferments of even up to 6 months, that it need not be dealt with as a troubled debt restructuring and have to be reserved by the lenders. Have you had those kind of conversations with your clients, Brent? Can't hear.
By the time it's gotten to me, most of the banks have already, and other non-bank lenders, but mainly banks in this case, have already determined that they were going to grant deferrals on payments. So frankly, I haven't really had the discussion of whether they should or should not, because in most cases they've already agreed to do that. I've even had a couple of deals that were already in forbearance where they've agreed to do that. So yeah, I think the banks, both my clients and as well as for my borrower side clients, when they've gone to the banks and asked for deferrals, they've gotten those relatively easy. In some cases, the banks, they'll want to do some diligence and see the financial health of the company. I've seen requests that the company deliver a 13-week cash flow statement in connection with that deferral. But on the deferral point, yeah, we've seen that quite a bit. That was kind of the as I mentioned, going on my chronology, that was the second week of this whole crisis, was trying to get deferments, and we processed a lot of those for clients.
So let me ask Adam and Brandon. I know this is presumably, frankly, a sensitive issue for the banks, but presumably you've had your borrowers come to you as well and have had these discussions with you. There's probably no one right answer that works for all, but can you give us some insight as to how you've at least looked at the situation?
Yeah, I can start. I mean, I think it's pretty consistent with what Brent was saying. I mean, banks are absolutely working with their borrowers, trying to think through deferrals and things that will be helpful. So things that have been out in the market, I think on average, right, banks are looking at 90 to 180 day deferrals. Obviously on the smaller end, right, consumer things like mortgages, those seem to be more automatic. The very small businesses, similar. I think for most, kind of commercial banks, they're all looking at deferrals as a way to help borrowers, but consistent with what, Brent was saying, they are looking at the, actual need, for the deferral. So, look at cash flows, liquidity, thinking through situations, how will the deferral work? But, absolutely, we're looking at them on a case-by-case basis. And as someone had brought up covenants, I mean, just the advice we're given on that, when there are covenant defaults and other relief that are needed from banks. I think the way borrowers ask for that and kind of partner with banks makes a big difference. So we're advising all our clients, let's talk every day if needed. Let's stay ahead of it. Let us be a partner with you. Tell us ahead of time, this is kind of coming up the horizon. How do we kind of work together on it? I've seen other situations where borrowers have said, hey, we were in default. We already did this, and I'm now asking for forgiveness. I think that goes over differently. So I think my main advice on this is banks are absolutely here, willing to help. We are all in this together. It's tough on everyone. So we want to help, but just kind of the way it's framed and the way, borrowers partner with banks to do this, I think makes a difference on, a lot of the things they're able to get.
Brandon, your thoughts?
Hey, I'll just add one thought, which is I think, the regulators being in front of this and making it clear to the banks early on that for clients who've clearly been broadsided by the pandemic, there is, like you guys said, flexibility for short-term deferrals and forbearance and covenant waivers to accommodate and help, those companies get through to the other side. And so I think we have been processing those. And as you could imagine, the industries that have been hit the hardest are those who require folks to walk in the door every day. So restaurants, retail, entertainment, lodging, and leisure, has seen probably a high level of activity, but there are borrowers everywhere who are impacted. So I think between dealing with this, deferments and other things, as well as PPP, the bankers have been working hard from their living rooms. That's for sure.
I would pick up on one point that Adam mentioned, which is about the how you go about it approach. I think, whereas sometimes you might think that it's easier to ask for forgiveness than permission, I think this is probably a scenario where that's not the case, especially because everybody's attention, everybody's got a lot going on. And so I think trying to be forward thinking and asking for permission for things from your bankers is actually probably more helpful now, rather than thinking, well, I'll just wait to deal with that fire and put it out when it happens. I think if you know of an issue, now would probably be the time to ask for, permission ahead of time.
100%. Yeah, absolutely agree.
All right, let's move the conversation along. One of the things I'd like to chat with you about, Brent, is, again, an area where we've seen a lot of communication that I'm sure has come over all of our emails, are the various provisions in loan agreements and any other kind of document that a client, a borrower can look to determine, are they still obligated to perform under the agreement, whether MAC clauses, MAE clauses, force majeure provisions, looking at impossibility and impracticality, all those kinds of things. Have you gotten into that with your clients? And if so, what advice can you offer to the folks who are looking at those kinds of provisions in connection with their loan obligations?
Yeah, so we've dealt with a bunch of different issues. Like I said, the first week, a lot of them were dealing with the reps, dealing with things about whether or not an MAE had actually occurred, dealing with notice provisions, for instance, which might require you to notify the bank if there's been an MAE or if there's been a default in one of your material contracts. In terms of the MAE issue, and on all of this, it really depends on the words that are in your particular credit agreement. So, whether or not, for instance, your MAE definition includes the word prospects in it could be really important. That being said, as a practical matter, I haven't seen our lender clients calling MAEs on the borrower side. It may be worth trying to get the COVID. You may not be able to get it carved out completely of the MAE, but you may be able to get it carved out in terms of for future advances. Can I exclude COVID impacts? So we've seen some discussion on that. And then in later weeks, what we've seen is folks looking at their debt covenants to see if they were even allowed to borrow under the Paycheck Protection Program, because in most agreements you wouldn't be in terms of the debt covenant. So we are now in the midst of counseling clients on how to get how to craft those provisions either from the lender or the borrower side. And some of the things to think about there is not just the debt covenant, but thinking about how it might impact your financial covenants, whether or not there's a mandatory prepayment provision in your agreement that requires you to prepay the senior loan from any other debt. You'd obviously want that excluded, because if you did pay the senior debt off from your PPP loan, then you wouldn't be qualified for the forgiveness portion of it. Folks were concerned about financial statement deliveries. Auditors are having a hard time getting out there and obviously and completing their audit. So we've seen folks asking for relief on that, instead of having to give it 120, 90 or 120 days, having some time period beyond that. And then I think what we're going to see is after this quarter and into the second quarter, you'll start realizing, okay, well, we're going to need some relief from our financial covenants generally. People will be asking for those carve outs on the MAEs. They'll be asking for extensions on various notices and financial statement deliveries. One of the other things, some of the minor stuff you don't think about was, hey, can I get this waiver via email, or do I need to get it actually signed? And that's been an issue in some cases because folks may not have a scanner at their house. So lots of various issues that are still making their way through this and are going to keep popping up.
Have you run into situations where there has actually been adversity where even if it's not a loan agreement, but simply, some kind of contract between the parties where one party has taken the position that they don't need to perform and the other side says you do need to perform?
I haven't seen it in the work I've been doing. I know we've had that come up. For instance, I know our construction group has looked at force majeure clauses. I haven't personally seen that. My guess is there's been some claims on that. On the lending side, that has not come up. Like I said, I think it's been a very cooperative nature amongst lenders and borrowers. I think it's a sense of we're all in this together.
One of the recent interesting head notes I saw of a case file that others might find interesting is that Bed Bath & Beyond just recently filed a suit, I think about 3 or 4 days ago in Chancery Court in Delaware, claiming that the MAE clause that this company 1-800-Flowers had invoked in order not to go forward with the transaction was invalid, that they shouldn't be entitled to do that. And the lawsuit alleges that the MAE clause didn't entitle them to do that because, as they alleged in the lawsuit, that millions of other businesses were in the same situation as 1-800-Flowers. So I expect that we probably will see a significant amount of litigation coming out of those kinds of provisions in the various agreements.
Yeah, I think what we saw when we were doing our research is in the loan context, we didn't see much in terms of going back to the financial crisis or before that, 9/11. We did see it in the M&A space. There is some case law there relating to M&A, but it mostly revolves out of the M&A or the M&A context rather than in the lending context.
So let me ask the two bankers on the line over here. We're in the midst of the loan processing. Where to from here? What's your focus for really, the balance of this week and next week? Do you see it changing, or is it still simply processing these loans?
Yeah.
Go ahead, Adam.
Okay. Yeah, I couldn't. It looked like Brandon was moving his mouse, so I couldn't tell. Yeah, I mean, for us this week, right? It's all PPP and it's all hands on deck, and we're just trying to, no matter what your position at the company, all work together to try to get as many of these processed and pushed through the system as possible. So I'd say this week and probably into next week, that's going to be the main focus. I think from there, we're going to start seeing more of the deferrals come into play. So I think, first and foremost, it's a $350 billion program. There's talk that it may upsize, but, we don't want to rely on that. So let's get those done for our clients. Let's work through the deferrals. And then, it's more real time, but obviously there was, kind of the new $600 billion program, which was made public today. We're already starting to have calls on that, today. And so I think going forward, that's going to be a big focus for the bank as well, helping some of the larger companies get capital.
Can you just give us some brief insight into that program?
Yes, I mean it's a new program, that was just launched. It's expected to be able to help larger companies up to $2.5 billion in revenue size, with a lot larger, 1,000 plus employee base. The loan amounts can be for existing clients and for new clients. Sounds and initial term sheets. We're up to 4-year tenors. It was a base rate. Plus 250 to 400 unsecured product, but there's I was on a call today with all the other banks that will likely participate in this program, and there's I think a lot to work through, similar to the PPP program. So while there's been kind of initial guidance on this, and the money's been set aside, I think in the coming days and weeks, you'll see some tweaks on the program to make it, I think, something that's going to be viable and helpful for our economy and our clients.
The one thing I would add on that, and we're getting up to speed on the program, and obviously there's been little guidance on that, and it's going to be a similar fire drill most likely as the PPP program, but it's just to distinguish it from the PPP program. There isn't a forgiveness portion, as I understand it, and so I think it's going to raise a whole bunch of different issues. So if folks are thinking, "Oh, this is just PPP," but for larger companies, I think that's probably the wrong way of looking at it. I think it's going to bring a whole host of other issues. There's going to be intercreditor issues because you have debt out there. So just thinking that, oh, we can brush off our analysis for the PPP program will not work. It's going to be a whole different analysis.
Yeah, no, Brent, you're spot on, and just the way it's structured, right? It's 95% government, but 5% to the banks, and to your point, it's unsecured versus secured. Do you have non-banks? Do you have other structured debt, intercreditors, security agreements? There's a lot behind the scenes that all the banks, with the government, are going to have to work through to make this viable. I completely agree.
Brandon, what does your crystal ball tell you for the next 10 days?
A lot more funding of PPP loans, I think, and I think more gradually dealing with, everything else that we've talked about. I think some of these things are still, starting to come to our attention as it, relates to just what we got to do to help out our borrowers. And so I just think, PPP, we're going to get it done. We're going to be more focused on prospects whose banks are unable to service them. And then we're going to continue to have to, I think, make adjustments to existing agreements to accommodate, all sorts of scenarios. So I think it's just going to be a busy time on all fronts, from my view.
So, Brent, when you look at the kind of full array of alternatives in helping your clients through cash management, what is it that you're saying to your business clients in looking forward, in trying to manage their cash and see themselves through to whenever we open up for business again?
So the first thing we probably did was advising, like I said, on deferrals and seeing if their lenders would work with them on deferring amortization payments and in some cases interest payments, and that has certainly helped. And the next was trying to see if you were eligible for the PPP program, which was a tricky analysis for a lot of folks. We unfortunately we had some clients that were just below the line and some that were just above the line in terms of the employee limit, and there were a lot of questions, and there wasn't real specific guidance until just recently as to how to calculate that. So that was a tricky thing, along with the affiliation rules. So that was the second part. I think a lot of folks will be looking at this Main Street lending program to see how this flushes out. So the folks who weren't able to qualify for the PPP loan program, but like I said, I think for a lot of them, it's going to be a little bit different analysis because it will be a debt with a zero forgiveness portion of that. So, but it's changing day by day, hour by hour. And then of course they're dealing, we after we get done with them, then we hand them off to our labor and employment group as well, because they're dealing with issues about furloughing employees in ways in which that can, save cash for themselves if they didn't qualify for the PPP program, furloughing employees so they can save that liquidity, but given some of the government assistance for employees, still leave those employees in a similar spot cash wise in terms of unemployment and the federal component to that. So that's where we're at.
One of the things that has struck me about the funding programs to date is that while it is true that the stimulus program is intended to get money into businesses and then through to employees, as we all know, at least the PPP program, which seems to be the main stimulus program for smaller businesses, is designed to be forgivable, at least to the extent that 75% is used for payroll. That's the forgiveness of those loans are premised on at least, again, 75% being used for payroll. That therefore assumes that over the next 8 weeks, that employers will get back to 100% employment in order to have those loans forgiven. So that seems to be an assumption I'm not sure is realistic, because payroll obviously is not the only expense in a business, and when you've got businesses that are shut down, they have zero other revenue that's coming in. Have you been talking to your clients about the issue of getting back to full payroll, or otherwise how they're going to deal with these loans down the line? Or are you just saying, look, let's just get the money now and we'll figure that out later on?
It's more a triage situation, to be candid, though obviously counseling them on what those proceeds can be used on. I mean, I think for a lot of them, folks appreciate keeping their employees on. It's going to be a lot more expensive. Even if all that money flushed through to the employees or to rent or utilities, which is what it's intended for, it still saves that starting back up cost of then having to rehire a workforce that you would let go of. And so I think there still is some benefit, even if you weren't able to use that for other expenses.
So Adam and Brandon, are those discussions anything that you've engaged with your borrowers, or again, has it been just strictly, the applications being submitted and getting those processed?
Yeah, I think the priority has been to help people get through the process, given the angst behind it, and that folks are worried that the funds will run out, and I think we all know that there's discussions now to approve additional funds for this program to try to ease that angst and make sure that all the businesses that can use it have access. But I think the thing you can all remember is that the downside risk for a company receiving funds that they potentially don't use is pretty low, because they can then pay back the funds. And so I think there's been an inclination to try to get through the process, bolster liquidity, and use that to continue to run the business, and then kind of figure out the forgiveness percentage and payback percentages down the line, right?
Yeah, I mean, our focus has really been on just liquidity, right, with clients, and advising them on putting together a 13-week kind of daily cash flow forecast to kind of understand where their liquidity is, and then just planning ahead, right? No one knows how long this is going to last, so planning ahead. What if this is 3 months? What if this is 6 months? What is this 12 months? What are kind of my base case, downside, kind of upside scenarios, and just being prepared to the best they can. And, decisions around, employees and things like that, obviously they're, doing on their own with advice from others, but we're just trying to help them, on the liquidity stuff, and just being ahead of this as much as they can.
All right, we've got maybe just a couple minutes. I don't know if there are any other final thoughts that any of you want to add before we wrap up the program.
No, I mean, I just say from our standpoint, I don't know that bankers and probably lawyers and accountants have ever been so popular. I mean, we're here, willing to help if anyone's got any questions. I think any of us are more than happy to jump on the phone and try to walk anyone through any scenario they need.
Yeah, I would agree with that. I know us as a firm, I mean, look, there's a human element to this as well. So we want to help. We're a business and we want to survive ourselves, but we also want to help people preserve their livelihood. So the reason I'm sitting here in a guest room is I've been probably at this computer about 20 hours a day, and then I'll take a 2 or 3 hour nap on that bed behind me, and then get up again and do it all over again.
Well, great. I'll jump in here, and I'll just say that was a terrific hour of content. I have a sense that we could reconvene this webinar in 48 hours and have a materially different discussion as quickly as all of this is evolving. But I want to thank again Brian Davidoff from Greenberg Glusker for moderating today's discussion. My thanks as well, obviously, to Brendan Ferreira, Fifth Third Bank, Adam Feit, Union Bank, and Brent Horstman, Shepherd Mullen. And speaking of timely content, I do want to take a moment to highlight the next webinar that we have scheduled for Tuesday, April 14th at 4 p.m. And the title there, COVID-19, the CARES Act and the Federal Response. Our speaker will be Jason Mulvihill. He's the Chief Operating Officer and General Counsel at the American Investment Council, an advocacy organization in Washington, D.C., representing the private investment industry. So Jason is very much on the front lines in D.C., advocating, working with, and lobbying Congress and the administration on behalf of private equity and the private investment community. So I think we're going to have another opportunity to hear, again, very timely and actionable information. So if you would, please register soon for that. Feel free to share with your colleagues. And again, thanks for attending today's webinar. Please be safe out there, and good night.
Thanks.
Good night all.